Welcome back to Gold Rush Reporter, where we uncover the real forces driving gold, silver, and global markets. Today, we're diving deep into one of the most misunderstood yet powerful assets on Earth, silver. The silver rabbit hole runs deep, very deep, and by the end of this breakdown, you'll understand why silver might not just be undervalued. It might be the most mispriced asset in the entire financial world. So, let's set the stage. Most investors look at silver's price, currently hovering in the low 20s, and assume it's a small player compared to gold. But price is not value. In fact, price can often be the greatest tool of misdirection. Silver's low price tag doesn't reflect scarcity or importance. It hides it. And that's the core of today's discussion. Silver's real-world demand and why the true numbers are far bigger than most people realize. Each year, the Silver Institute releases data about silver's industrial and investment demand. They list categories like solar, electronics, jewelry, and silverware. But what if I told you that two of the biggest consumers of silver aren't even fully included in those reports? Those two hidden sectors are military and aerospace. According to recent independent research, these two industries might use more silver than electric vehicles and solar panels combined. And yet, their consumption isn't directly reflected in official numbers. That means the world could be severely underestimating silver's real deficit. Let's talk about why that matters. The US Department of Defense stopped reporting its silver inventories back in 1995. Since then, data has been spotty at best. Silver is used in missile guidance systems, satellite components, and advanced weapon technologies. For example, a single Tomahawk missile can contain roughly 500 ounces of silver. All of it destroyed upon impact, never recycled, never recovered. Multiply that by the scale of global military operations, and you start to see how massive this unreported consumption might be. And this isn't a small discrepancy. It changes the entire outlook. The Silver Institute might report a 140 million ounce annual deficit, but if military and aerospace demand are undercounted, that shortfall could easily be double. Some analysts suggest the world's true silver deficit could exceed 300 million ounces per year. And that's before accounting for rising demand from electric vehicles and renewable energy. Now think about what happens when supply can't keep up. Each year, global mining produces around 800 million ounces of silver, while industrial and investment consumption pushes well above 1.2 billion ounces. That's a gap of nearly 500 million ounces over just a few years. And the market can't simply print more silver to fill that hole. It takes years to open new mines, and many existing ones are depleting fast. So, while mainstream investors are distracted by gold, stocks, or crypto, a silent crisis is unfolding in the silver market. This isn't about speculation. It's about math, geology, and physics. The numbers simply don't add up. And when markets ignore that kind of imbalance, they always correct. Violently. In this series, we'll explore why silver's demand is exploding across energy, tech, defense, and finance, and how countries like India are preparing to use silver as a monetary asset. Once again, we'll also break down why analysts believe silver could outperform not just gold, but every other major asset class in the years ahead. So buckle up, because what you're about to learn might completely change how you view this precious metal. This is your daily dose of truth from Gold Rush Reporter, your trusted voice in gold and silver analysis. Stay tuned for part 2, where we'll unpack the unseen demand drivers and how they're reshaping the future of silver. When we look beyond the surface, silver's true demand story becomes almost shocking. The world keeps treating silver like a secondary metal, yet every year it becomes more essential to modern life. And the crazy part? Even though demand keeps climbing, production can't keep up. Not even close. That's what's driving what experts call a structural deficit in the silver market. Let's start with the industrial side. Right now, silver's four main demand pillars are electronics, military and aerospace, solar, and investment. Combined, these sectors consume more than 1 billion ounces of silver annually, and every single one of them is growing. Electronics alone are driving demand through the roof. Silver is used in smartphones, tablets, computers, AI data centers, and autonomous vehicles. Basically, every piece of high-tech infrastructure you can think of. The reason? Silver has the highest electrical and thermal conductivity of any metal on Earth. There's no replacement for it. Now let's add the next sector: military and aerospace. This one doesn't get nearly enough attention. Silver's unique conductive and reflective properties make it critical for missile systems, drones, satellite communications, and advanced aircraft. In fact, silver zinc batteries are relied on in military operations because of their unmatched reliability in extreme environments. Think about what that means. The more global tensions rise, the more silver the world quietly consumes, and none of it is recycled. Once it's used, it's gone for good. Then we move to solar, another demand monster. Solar panel manufacturers are currently hoarding silver to secure their supply chains. In 2025 alone, the industry is projected to consume 150 million ounces of silver. Why? Because silver is the best conductor for photovoltaic cells, the core component of solar panels. You can't swap it out for copper or aluminum without sacrificing efficiency. As the world races toward renewable energy, that demand is only going to explode. And finally, there's investment demand. From India's rural savers to Western ETF buyers, silver's reputation as a safe haven asset is surging again. Paper silver markets, the futures and derivative contracts traded on exchanges, are starting to drift away from the reality of physical supply. The result? Premiums on physical silver are climbing, especially in Asia. Investors are realizing that real metal is scarce, and when supply tightens, owning paper claims won't mean much. So what happens when you put all this together? You get a market that's operating with our 5-year cumulative deficit of around 900 million ounces. Meaning that the world has used almost 1 billion ounces more silver than it has mined. This isn't a temporary shortage, it's structural, meaning it's built into the system and getting worse every year. Now, add a layer of innovation to this story: solid-state silver batteries. Companies like Samsung are testing electric vehicle batteries that use up to 1 kilogram of silver per vehicle. At mass production levels, that single innovation could consume nearly an entire year's worth of mining output, just for EVs. Imagine the strain that puts on a market already short hundreds of millions of ounces. By 2026, global EV production could require between 750 million and 1 billion ounces of silver per year. And that's without including solar, electronics, or military use. The math doesn't work, and markets eventually correct these imbalances, often with massive price spikes. So, when analysts say silver could outperform every other asset, it's not a hype statement, it's logic. When supply can't match demand, and when the asset in question is essential to energy, defense, and technology, price is forced to adjust dramatically. In the next part, we'll go deeper into how countries like India are reintroducing silver into their financial systems, creating not just industrial demand, but monetary demand, something we haven't seen in over a century. Now let's talk about one of the biggest silver stories that's quietly unfolding: India. For decades, India was known as a gold-obsessed nation, and it still is. But something fascinating has changed over the past few years. Silver demand in India has absolutely exploded, and it's reshaping the global market in ways most investors haven't even noticed yet. In 2024 alone, India imported over 9,000 metric tons of silver, the highest level in history. To put that in perspective, that's roughly 290 million ounces, almost 1/3 of total global mine production. And this surge isn't coming from industrial use. It's coming from everyday people, rural savers, small investors, and the jewelry market, who are now choosing silver instead of gold. So, why is this happening? It comes down to affordability and opportunity. As gold prices climb, silver becomes the more accessible precious metal for millions of people. A single ounce of gold costs over $2,400, while silver trades under $30. For the average Indian household, silver is the logical entry point into hard assets. It's real, it's tangible, and it holds purchasing power over time. There's also a deep cultural connection at play. In India, silver is tied to tradition, weddings, religious festivals, and wealth preservation. During Diwali, Akshaya Tritiya, and harvest seasons, silver coins and ornaments are purchased as symbols of prosperity. That consistent demand base means that even during economic slowdowns, silver continues to flow through the market. But there's a second, more strategic layer to this story. India's government and financial institutions have started to look at silver not just as a consumer good, but as a monetary asset, something that could strengthen financial resilience. With the rupee facing ongoing inflation pressure and the global dollar system showing cracks, silver is re-emerging as a backup form of savings. Small banks and microfinance institutions in India are now offering silver-linked savings plans, where investors can deposit rupees that are pegged to the current value of silver. It's not full monetization yet, but it's a clear signal. Silver is slowly being pulled back into the financial system. And if that trend accelerates, we could see a massive shift in how developing economies store value. The impact of this goes far beyond India. When 1 billion people start saving in silver, global inventories tighten fast. Remember, the silver market is tiny compared to gold. All the above-ground investable silver in the world is estimated to be around 2.5 billion ounces. If Indian households alone start accumulating 200 to 300 million ounces annually, the available global float could dry up in just a few years. This trend is already sending ripples through international trade. Refiners in Switzerland and the Middle East are ramping up operations just to meet Indian demand. Premiums for physical silver bars in Mumbai and Ahmedabad have hit record highs, a clear sign that physical supply is lagging behind retail appetite. And let's not forget China. The Chinese solar and electronic sectors are hoarding silver too. Between India's monetary demand and China's industrial demand, the competition for available silver is turning into a quiet tug-of-war. Whoever secures physical metal first wins, and everyone else pays higher prices later. The key takeaway here is that silver is transforming from a commodity into a strategic asset, one that bridges the gap between money and technology. It's no longer just something you buy for jewelry or investment. It's becoming part of the global financial defense system, a hedge against both inflation and digital fragility. In the next part, we'll dig into the supply crisis, why new silver discoveries are drying up, why mining output has stagnated, and how recycling alone can't fill the gap. Because when the supply side breaks down, that's when price truly goes vertical. Now let's dive into the real bottleneck of the silver market. Supply. This is where things get serious because unlike gold, silver isn't mined primarily for its own sake. Around 70% of global silver output actually comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver production is heavily dependent on the economics of those base metals, not on silver's own price. So even when silver prices rise, mining companies can't just flip a switch and produce more. They'd have to open new base metal mines, an expensive multi-year process that requires billions of dollars in investment. And since copper and zinc prices have been volatile, very few new projects are coming online. The result? A tightening supply chain that's now struggling to keep up with global demand. According to the Silver Institute, the world mined about 820 million ounces of silver last year, but demand was closer to 1.2 billion ounces. That's a 400 million ounce deficit, one of the largest shortfalls in decades. Some of that demand was met through recycling, but even recycling has its limits. Industrial scrap recovery is declining, and much of the silver used in solar panels and electronics can't be easily reclaimed. This supply crunch is being felt most sharply in the physical market. Mints, refiners, and bullion dealers are reporting extended delivery times, higher premiums, and reduced availability of popular products like 1-ounce rounds and 100-ounce bars. If you've tried buying physical silver lately, you've probably noticed it yourself. The waiting lists are getting longer, and prices are climbing faster than spot. But the real warning sign is what's happening at the mining level. Major producers like Mexico, Peru, and China, the top 3 silver mining countries, are all facing structural declines. Mexico has seen stricter environmental laws, labor disputes, and higher royalty taxes that discourage new projects. In Peru, political instability and community protests have slowed operations. And in China, many older mines are simply running out of high-grade ore. That's a dangerous combination: rising demand and falling output. It's like watching a dam slowly dry out while more people keep turning on their taps. Sooner or later, something has to give. Some analysts have suggested that the solution lies in new exploration, but even that's a challenge. Finding silver deposits that are economically viable has become increasingly rare. The easy silver, near-surface, high-grade ore has already been mined. What remains is deeper underground, lower in concentration, and far more expensive to extract. Meanwhile, the cost of energy, equipment, and labor is surging. When you add inflation to the mix, the true cost of mining silver keeps climbing, which in turn puts more pressure on future prices. Many miners are reluctant to expand unless silver stabilizes above $35 to $40 per ounce, a level that would justify new investment. Until then, they're playing it safe. And that's keeping the market undersupplied. Another underappreciated factor is nationalization. Some governments are starting to treat silver as a strategic resource, not a commercial one. Countries like Bolivia and Mexico have hinted at tighter control over domestic mining to preserve national wealth. That could mean less silver flowing to international markets and more being held back for domestic reserves or currency backing. So, when you combine the macro view, falling mine supply, rising industrial consumption, booming retail demand, and tightening inventories, it paints a clear picture. We're heading toward a structural supply squeeze. And here's the kicker. Markets rarely price in shortages until it's too late. When the realization hits that above ground, silver stocks are draining and new supply can't keep up, that's when you get what analysts call a supply shock revaluation. Prices don't just rise gradually. They explode, often in a matter of weeks. In the next part, we'll explore how that explosion could unfold. psychological tipping point, the role of ETFs, and why paper silver might be the weakest link in this entire chain. Because when trust in synthetic silver collapses, that's when physical ownership becomes king. Now that we've covered the supply crisis, let's move to what might be the most misunderstood part of the silver market: paper silver. This is the side of the market that exists mostly in financial form: futures contracts, ETFs, and other synthetic products that claim to represent real silver, but rarely involve any physical metal. At first glance, paper silver looks like an easy way for investors to gain exposure to price movements without dealing with storage or shipping. But beneath the surface, it's a fragile structure, one that could break under pressure. Because the truth is, there's far more paper silver traded on global exchanges than there is physical silver available in the world. Let's take the COMEX, for example. At any given time, the open interest in silver futures represents hundreds of millions of ounces. Yet the registered silver in COMEX vaults often sits below 100 million ounces. What? That's a leverage ratio of more than 10 to 1 tuln. In other words, for every real ounce in storage, there are 10 ounces being promised on paper. This system works only as long as most traders settle their contracts in cash. But if confidence in paper silver collapses, if even a small percentage of investors start demanding physical delivery, the whole system could unravel quickly. COMEX simply doesn't have enough physical silver to meet those claims. The same goes for many silver-backed ETFs. They hold large pools of metal on paper, but their fine print often allows for substitution or cash settlement in the event of shortages. That means if you own shares of a major silver ETF, you might think you own silver. But in a real crunch, what you actually own is a pic camp promise, not the metal itself. This is what makes the silver market so dangerous and so potentially explosive. As physical supply tightens, especially from countries like India and China, more investors will start to question whether their paper claims are really backed by anything tangible. And when that doubt spreads, you'll see a stampede into physical metal. Think of it like a bank run. Everyone is fine until a few people show up demanding withdrawals. Then the illusion of solvency disappears overnight. The silver market operates on the same principle. It's built on trust. The belief that there's always enough metal somewhere to meet demand. But history has shown, time and time again, that trust can evaporate in an instant. If this paper versus physical disconnect widens, prices will respond violently. Paper prices could temporarily collapse as markets freeze, while physical silver premiums skyrocket due to scarcity. In other words, you might see the official spot price say $28, but real silver bars selling for $60 or more in the open market. And that kind of dual pricing would change everything. It would expose how manipulated and over-leveraged the system really is. Institutions that rely on futures contracts for hedging could be left without protection. Industrial users might struggle to source metal at any price. And ordinary investors, the ones holding coins and bars in hand, could suddenly find their wealth doubling or tripling overnight. This is why analysts like to call silver a truth detector. For the monetary system. When confidence in fiat currency or paper assets begins to waver, silver reveals the real state of balance, or imbalance, underneath. In the next and final part, we'll look at how all of this might unfold in real time, what triggers could set off a silver revaluation, how investors can prepare, and why this could mark the beginning of a new monetary era, where physical metals reclaim their rightful place as the foundation of value. Stay tuned. This is where it all comes together. So here we are, the final and most critical part of this story. We've covered demand, supply, and the fragile paper system that hides the truth about silver's real value. Now it's time to connect the dots and ask the big question. What happens next? How does silver finally break free from its manipulated pricing and show its true worth? The answer lies in a series of trigger points that can cause a global revaluation almost overnight. The first is a monetary shift, a loss of confidence in fiat currencies. Central banks are printing money faster than ever, and inflation is quietly eroding purchasing power across the globe. When people realize that paper savings are melting, they turn to real assets. Gold usually moves first, but silver follows with far greater momentum. That's when you see silver outperform everything else, just like it did in 1979 and again in 2011. The second trigger is persist. Industrial scarcity. As the clean energy revolution accelerates, silver demand from solar, EVs, and tech continues to grow. But with mining output stagnant and recycling limited, the moment industrial users start competing with investors for the same ounces, prices will have no ceiling. The market simply won't be able to supply enough silver at current levels. The third trigger is a paper market failure. What we talked about in the last part. The day investors demand physical delivery instead of paper promises, we could see an instant shortage. And that's when we'll discover what real silver is worth, not the price dictated by a few traders on Wall Street. Now let's imagine this revaluation unfolding. The COMEX futures price begins to disconnect from real-world premiums. Dealers stop selling at spot because their inventory costs more to replace. Silver ETFs face redemption delays. The media calls it volatility, but in reality, it's a repricing. Silver reclaiming its historical role as honest money. Within months, we could see silver doubling or even tripling as the world realizes there simply isn't enough to go around. This isn't speculation. It's a natural consequence of decades of underpricing a finite resource that powers modern technology and represents ancient wealth. The illusion of abundance is breaking down, and when it does, only those holding physical silver will truly benefit. So, if you're watching this and wondering what to do, the message is simple. Get educated, stay patient, and think long-term. Don't chase short-term price swings. Focus on accumulating real, tangible ounces that you can hold in your hand. History has shown that when the financial system resets, it's the holders of hard assets who come out on top. Because at the end of the day, silver isn't just an investment. It's a form of financial insurance. It protects you from currency debasement, political instability, and digital fragility. It's real money for a digital world, and its time is coming again. All right, guys, that wraps up our full deep dive into the hidden power of silver, from India's surge in demand to the global supply crunch and the ticking time bomb of paper silver. If you found value in this breakdown, make sure to like this video, subscribe to Gold Rush Reporter, and share it with someone who needs to understand what's really happening behind the scenes. I've got more in-depth reports and analysis coming soon. So stay tuned. This is Gold Rush Reporter, helping you see beyond the headlines and into the real value of gold and silver. Thanks for watching, and I'll see you in the next one.